is titled, Why is my cash flow projection off? Um, and we're going to focus on 8 frequent accounts that are the culprits. This workshop is sponsored by Machias Savings Bank. Thank you very much, Machias Savings Bank, as well as by the Small Business Administration, who sponsors many SCORE things as an underwriter of SCORE. So if you would, I would appreciate it if you could tell me a little bit in the chat window about the industry you operate in and any specific questions you might have about cash flow, because that will help me to address things as I go along. So don't hesitate to throw that in the chat window. And if you have any questions, please ask them immediately. You're welcome to unmute yourself at any time and ask away, because there's no substitute like asking them when they're in the front of your mind. So the 8 accounts that I'm going to focus on are 5 from the balance sheet and 3 from the income statement. These are the accounts that are often responsible for people's cash flow forecasts being off the most significantly. There are many other possible accounts that could have an impact, but these accounts tend to have the largest impact. So we'll go through these one at a time, and we can talk about specific examples. And in particular, I'm also going to try to explain why these accounts have an impact on your cash flow as well. For each of the accounts, we're going to ask ourselves, first of all, was there a significant change in this account between an earlier period and now? If so, why did that change happen? Because understanding that is important to you managing your business. Was that change consistent with the change in your revenues over the same period? Because many of these accounts tend to be driven by your level of revenues. And then lastly, was the change one that you had projected in your cash flow forecast? And if not, well, that would obviously explain why your cash flow forecast might have been off. But many changes have been projected, maybe not quite enough or too little, or rather too much. These are the basic questions to ask yourself as you go through your financial statements, trying to analyze your cash flow over a past period and try to figure out why it may not have been consistent with what you might have forecasted. So starting off with the balance sheet accounts. If you're not familiar with your balance sheet, a balance sheet shows what your business owns, what it owes at specific points in time. It's a snapshot of your business's, if you will, financial condition at one or more points in time. You could look at balance sheet by quarter, by month, by year. There are many ways of looking at it depending on what you are trying to figure out at the moment. The balance sheet as shown in your financial statements can show more or less detail. That's your choice. And if your chart of accounts is very detailed, then your balance sheet may show more detail than is helpful. If your chart of accounts is not very detailed, then you may not be able to get much detail out of your balance sheet. But that's something you can change. You can always modify the chart of accounts that your business is using. Talk to your accountant about it. If your chart of accounts is not providing you with the information that you feel you need in order to understand your business better. So the first account on the balance sheet we're going to look at is accounts receivable. Accounts receivable are the amounts that are owed to you by your customers for sales that you have made to them. Generally speaking, if you are using cash accounting, you won't have any accounts receivable because you won't recognize something as income until you actually receive the cash from your customer. And at that point, obviously, they don't owe you anything. But if you use accrual accounting, then You may recognize the revenue at any number of times in the process of the sales cycle. You could recognize the revenue when you get the order, or when you ship it, or when it's received by the customer, or perhaps at a far extreme, when the warranty runs out. Those are all possibilities, some more realistic than others. But if you recognize revenue earlier than the customer actually pays you, then you will have that balance showing in your accounts receivable. So accounts receivable reflects amounts that you recognized as revenue but have not received yet. And so the big question is, has accounts receivable grown faster than revenues? So in the example at the top right, you see accounts receivable have grown by 44%. If revenues also grew by about 44%, then that would seem pretty normal. But if revenues grew by 30%, while accounts receivable went up by 44%, that might be rather odd. Maybe you recently extended credit to some new customers. Maybe you changed your policies, or maybe some customers have not been paying on time. There are any number of possible explanations, but to dig down and get to the bottom of them, you need to look into your accounts receivable at more detail. Your accounting software should provide you with an accounts receivable aging report, which lets you look at the balances that are overdue by, say, a month or 2 months or 3 months, and so on, and would let you quickly identify which customers are responsible for the most overdue balances. And if the problem is happened because of overdue balances, then it's entirely different than if the problem happened just because your sales have grown and your proportion of sales that have not been paid has remained constant. So one frequent oversight in a cash flow projection is to account for the percentage of your revenues that tend to be in accounts receivable, that tend to be sold on terms. And if you're projecting sales growth, then you should also project a growth in your accounts receivable. And that will mean that there'll be a delay between the time that you recognize the sale as revenue and the time that you receive cash for that sale. Now, that can be a problem if you need to rebuild inventory. The product has left your shop and you need the money to buy a new one, but you haven't received the money yet. So if accounts receivable goes up, generally that means that the amount of the increase will represent a decrease in the amount of cash you otherwise would have expected to have. So in this particular example, accounts receivable has gone up by $40,000. Therefore, I probably have $40,000 less in cash than I would have expected. And that obviously could have a big impact on your actual cash flow during the period. So any questions about accounts receivable? Okay, next up is inventory. Inventory is or consists of items that you have on hand for sale or for manufacturing into something that you can sell. So if you don't have inventory, for many businesses, that often means that you can't sell it because you don't have it. Now, if you're drop shipping everything from your vendor directly to your customer, you might not have to carry any inventory. That's true. But for many businesses, they do carry an inventory of items that they have for sale. And obviously, to build that inventory, you had to buy those products, and buying those products consumed cash, unless the vendor gave you terms and let you pay in, say, 30 or 45 days. Um, if you can get those terms from your vendors, that's great because they're helping to finance the growth in your inventory that you need to support the growth in your sales. But if your vendors won't give you terms and insist upon being paid upon order or upon shipment, which is pretty typical, then you will need cash in order to build your inventory. So if you expect sales to double next month, maybe you need to double your inventory, which means you potentially need to double your investment in inventory, which can have a big effect on your cash balance. So watch your inventory levels very carefully, particularly in relation to your revenues. If you expect revenues to be relatively flat, then presumably inventory should stay relatively flat. If you expect revenues to go up by 20%, then perhaps inventory needs to go up by 20% as well. Maybe it's 15%, maybe it's 25%. I don't know, depends on your business and exactly what you have in inventory. But in general, the two tend to go in approximate lockstep. Ways to reduce that problem and to reduce your cash needs if you need to build inventory are to get vendors to offer you terms. Never hurts to ask, hey, would you mind letting me pay in 2 weeks or 4 weeks or 6 weeks after you ship? If you're a good customer, they might be willing to consider that. That will reduce your cash needs. And if you're good, you can sell the new inventory before you have to pay for it, which is what Costco tries to do. And therefore, much of your inventory ends up being financed by your vendors. How nice is that? However, if your inventory does not turn over very quickly and you cannot sell it before you have to pay for it, then a growth in inventory will consume cash. So the big question is, did the change in inventory make sense? Did it grow or shrink? As in this case, you can see up here at the top right, it shrank by 14%. Was this consistent with what happened to revenues? And was this change needed? So we haven't looked at revenues for this company yet, so we can't really answer my revenues question. But in this case, having inventory go down while accounts receivable went up is a little odd. And my first guess about a company like this might be that it had discovered that it had excess inventory and it's been doing a good job of working down inventory at the same time as sales have gone up. This could also be something that happens if you have a seasonal business. And as you reach the end of your big season, you'd be usually working to work down your inventory so you don't have to carry all the excess inventory through your slow season. And at that point, your accounts receivable might be high because you just finished your busy season. So inventory is the other big account to think about in a cash flow projection. How much do you think inventory is going to need to change to support the level of revenues that you're projecting? And it varies a great deal from one industry to another, one type of business to another. So only you, as the owner of your business, can really determine what level of inventory is needed for the expected volume of sales. Next up come fixed assets. Fixed assets in your balance sheet consist of things like land, buildings, machinery, vehicles, anything that has a long life and therefore is likely to be depreciated over its life on your income statement and on your balance sheet. So in this example use of a balance sheet that you see here on the right, you see in bold, it says fixed assets. And then underneath it, it has machinery and equipment listed at the cost to purchase them, followed by the accumulated depreciation on that machinery and equipment. So As of the end of 2022, they had net fixed assets after depreciation has been subtracted of 145,000. And at the end of 2023, that had gone down to 125,000, even though the total amount invested in machinery and equipment had gone up by $30,000. However, because depreciation went up by $50,000, the net amount went down. So depreciation, it can be weird. Some companies may depreciate things on a nice steady depreciation schedule, roughly depreciating the same amount every year for the life of the object. But there are many other possible depreciation approaches that can be used that your accountant may recommend for tax reasons, which allow you to accelerate the depreciation of recently purchased items so that you depreciate them very quickly for the first few years and then more slowly for the remainder of their life. That saves you taxes in the first few years, but then has you paying more taxes in the later years. But a dollar now is worth more than a dollar later. So reducing your taxes this year is usually better than delaying that reduction by a year. Anyhow, so whether or not you use accelerated depreciation, your investment in machinery and equipment, in this case, $30,000, is going to have to come from somewhere. In some cases, that may reduce your cash. In other cases, you may have increased your borrowing to fund this purchase. If you borrow the money to fund the purchase, then maybe it did not have a big impact on your cash, although you probably had to make a down payment from the cash that you did have. If you paid for it entirely in cash, then it definitely all would have an impact on your cash. So on the left here, I say that purchase or sale of a fixed asset affects cash and partially affects profit. Well, when you purchase a fixed asset, you have to pay the cash, but purchasing an asset does not affect your profitability. It's only the depreciation you take on the asset during the calendar year or the fiscal year that affects your profitability. When you sell an asset, you may sell it for more than its depreciated value in your books, in which case that gain will be recognized as profit in that year. And part of the cash you receive from selling the asset will be taxable as profit. So selling a fixed asset will have the full value that you receive for the asset affecting your cash balance. It'll increase your cash, but only your gain on that sale, if any, will affect your profit and therefore the taxes you owe. If you lose money on the sale of a fixed asset relative to its depreciated value, then that will reduce your income and reduce your taxes that year. Mostly, I wouldn't worry about the after-tax effect as much as I would think about the cash effect of buying or selling a fixed asset. If your fixed assets that cost changes, in this case by $30,000, that probably meant that $30,000 left my cash account to increase my fixed assets. So one way of reducing the impact on cash is to consider renting or leasing instead of purchasing something outright. By renting or leasing, you avoid that initial outflow of cash. It might cost you more over the life of the asset, but for now, it saves you cash. And if your business needs cash to grow, for example, then leasing or renting equipment instead of buying it or buying it on a loan may make a lot of sense. Even though it costs you a bit more in the long run, it preserves your cash, which is the critical asset you need to operate your business. So having cash available may be more important to you than achieving the lowest possible cost in acquiring a fixed asset. And then my usual question, was the change that happened in fixed assets something that you had projected as part of your cash flow forecast? If not, that's something to make a note of for your next cash flow forecast. Because if you know that you're likely to either purchase or sell fixed assets during the period you're forecasting over, then you want to include the cash needed or received in your forecast. Any questions on fixed assets? Okay, next up is accounts payable. So here we are moving from the asset portion of the balance sheet into the liabilities and owner's equity portion of the balance sheet. And I just noticed the typo on the top right. It doesn't say equity. Anyhow, accounts payable are amounts that you owe to other people or companies. Typically, accounts payable are amounts owed to your vendors. And for many companies, accounts payable are either zero or only represent their company credit card balance. But if your vendors have agreed to offer you terms, and when you buy stuff for inventory, you don't have to pay for it for 2 weeks, 4 weeks, 6 weeks, whatever, then those balances would sit in accounts payable until the time that you send them a check. So if you're building up inventory and you are buying it on terms from your vendors, then you would expect your accounts payable to rise. In this case, it's risen by $25,000. Now, the way a statement of cash flows works is it starts with your profit, and then it adds back depreciation, which had been subtracted in calculating profit. But since depreciation is not money you actually spend, it's not an actual cash outflow, so it's added back to profit. And then it goes along and it takes the change in your accounts receivable. If accounts receivable increased, well, that means that you did not receive cash that you might otherwise have expected to receive. Therefore, your cash flow is reduced by the amount that accounts receivable increased. And similarly, accounts payable, in this case, increased by $25,000, which means that you did not pay $25,000 that you otherwise would have expected to. And therefore, an increase in accounts payable increases your cash balance. So if you expect to receive terms from vendors next year and have your accounts payable balance grow, the growth in your accounts payable should add about that amount to your available cash balances in your checking account. So it's in your interest to manage your accounts payable closely. Many accounting packages, much accounting software, will allow you to enter every invoice you receive into the accounting software so that it can remind you of when that invoice is due so that you don't pay any invoice before you need to. And that way you can meet the terms that your vendors have offered you, but hold on to that cash for as long as you can inside your company to give you greater operational flexibility. So first of all, yes, you should think about whether accounts payable are likely to change over the period of time that you're forecasting in your cash flow forecast. But then secondly, you should also think about, can I manage my accounts payable more aggressively as a potential source of cash for my business? Granted, it'll be short-term cash because you need to pay the bills when they're due. But if you hang on to that money for just one more month than you otherwise might have, that might do wonders for the average balance in your checking account and let you sleep better at night. Any questions on accounts payable? Okay, next up are your debts. Any loans that the company has have a number of impacts on your financials. When you first receive a loan, that loan balance will increase your cash by the full amount you receive. So a loan does wonders for your cash. And then you start making payments on the loan. And each payment has two parts to it: the principal and the interest. The interest payment reduces your income for the period and therefore reduces your taxable income. The principal payment is just returning cash that's actually the bank's cash to the bank, and therefore is not considered an expense to your company and will not appear anywhere on your income statement. So many people projecting their cash flow will very correctly include all of their interest payments, but they may often forget to also include all of their principal payments that are required on outstanding loans. So that can be another big source of a cash flow being off if you did not include your loan principal payments in your cash flow forecast. So most people focus very rightly on their income statement, and that's the place to start, yes. But when you're done forecasting the results of your income statement, don't forget to consider capital expenditures for new fixed assets or selling old fixed assets, as well as your loan principal payments, which have not been included as an expense in your income statement. So if you repay a loan or you expect to pay off a loan before it perhaps is fully repaid just by virtue of the regular monthly payments, then that pay down will also consume a lot of cash typically. So think carefully about your long-term debt and whether that's something that you anticipate repaying during the period that you're forecasting cash flow for. And remember that you are repaying it in small chunks every time you make a payment via the principal component of each monthly payment. Any questions on loans? Okay. So to summarize balance sheet items, these are all things I've just mentioned, but just to repeat things. Any changes that you expect to accounts receivable, either growing or shrinking, will have an impact on your cash flow, and they should be included in your cash flow projection. Similar, any changes in inventory should also be reflected in your cash flow projection. If you expect to purchase or sell fixed assets, the purchase will decrease your cash. Sale of fixed asset will increase your cash. If you expect accounts payable balances to change, the change in the balance will also affect your cash. If accounts payable go up, your cash will go up. Whereas if accounts receivable goes up, your cash goes down. And lastly, your loan principal payments or payoffs or new loans will all also have a big impact on your cash.
Hey,
Any
what,
questions? Yes.
Frank, can you go back to this slide, the one prior to this? Yeah. Another item that doesn't affects cash, that doesn't show up on the P&L is draws and distributions.
Good point. Yes.
Yeah. So,
Excuse me. That would be down in the owner's equity section, where essentially, if you take a draw as the owner, that is not considered an expense to the company. Therefore, it does not appear on your income statement. So any draws that the owner takes out of the company will typically reduce paid in capital or retained earnings at the end of the year and reduce your total equity. In this case, draws are a separate line, in which case they'd be listed there for the moment. Typically at year end, there's a journal entry which would take all the draws for the year and use them to reduce paid in capital. Because a draw represent you as the owner taking capital out of the business. And that, if you're taking a lot of money out of the business, that will hurt the business's cash. So thank you for pointing out. Frank, I will add it to the slide deck for the next
okay.
time. Other questions? Okay. Turning to your income statement. Your income statement shows the income and expenses and then calculates the profit or loss of the business over a period of time. So whereas the balance sheet was a snapshot, typically at 2 periods in time, the income statement shows you the change between those 2 dates. And once again, like with the balance sheet, you as the owner of the business can determine how much or how little detail your income statement contains. Some people like to have a lot of detail. Some people prefer to have less detail. That's entirely your choice. But what's important is that it have enough detail to help you manage the business. So in this case, the income statement shows sales or revenues grew by 8%. Now, if you think back to the accounts receivable that we looked at earlier, which had grown by 44%, whoa, something is wacky with those accounts receivable. Why did they grow so much? Probably this business started offering terms to people that had not received them previously, or they have some customers that aren't paying on time. Anyhow, back to revenues. In this case, they grew by $50,000, 8%. That's not bad. Was this the amount by which you might have projected they would grow? If this growth was less than projected, then that would have a significant impact on your cash flow typically. If the growth was more than was projected, then that also would have a significant impact on your cash flow. Your sales typically will obviously affect your profits, but your general level of sales also affect most of the accounts that I talked about previously. So if sales are going up, inventory goes up, accounts receivable goes up, accounts payable might go up too. If sales are going down, then all of those might go down. So if sales did not meet your projections, then you may have to look at your projections for all of the accounts I've mentioned so far, not just revenues. And as you look at your sales projection and think about how reality corresponded to your sales projection, I do encourage you to dive in a little bit deeper and look at the proportion of sales you receive from each product or service. You're often going to be just as interested in whether each sort of major area of your business behaved as you expected to, or maybe whether one area was more successful and another was less successful even though it averaged out to meet your projection. So it's often quite helpful to dive down and look at sales by division or by product type or by service versus products, or however your sales might be broken down in your particular type of business. The next important thing to look at is your gross margin. Gross margin is calculated by taking your sales and subtracting the cost of goods sold. I would note that cost of sales or cost of goods sold includes the cost of the products that you purchased or the cost of making them, including the labor that went into making them if you made them yourself in your company. But cost of goods sold does not include sales commissions, and it does not include marketing expenses. It's only the cost of producing and storing that product for sale. So all of your inventory storage costs count as cost of goods sold. And if you take sales less cost of goods sold, you end up with your gross margin. That's the dollars you made on that sale that you have available to cover all of your other overhead expenses, including marketing. So typically, people watch their gross margin as a percentage of sales. And so on the bottom line here on the left, you can see that gross margin in 2022 was 27% of sales, and in 2023 rose to being 30% of sales. So that means that they've managed to reduce the cost of the goods that they purchased as a percentage of what they were selling them for. So they now have more money per dollar of sales to devote to their overhead costs, which is a good thing for any company. So their sales grew by 50,000, but the cost of sales only grew by 15,000. And that all goes straight to the bottom line, potentially, if other expenses didn't grow. So their gross margin grew by almost 22%. And that's awesome. That comes typically from shopping around, finding other vendors who can deliver the product you want at a better price or in better terms, or both. Or it comes from raising your prices, even if you can't get the actual products at a cheaper cost. Either way, your gross margin is a key number for you to track every month. And if you see it changing, figure out why. Is it because you've offered a sale? Is it because your vendors are changing their prices? What? Understand why your gross margin is behaving as it does, and look at your gross margin carefully every month, because you don't want to let it get away from you. If it shrinks unintentionally as a percentage of sales, then your cash balance will suffer because you're not making as much money on every dollar of sales. And you probably also want to examine your gross margin as a percentage of sales revenue by type of product, or by division, or whatever you want to call it in your company. So if you sell products and sell services, look at your gross margin for services this month versus last month, in the same way that you look at your gross margin for products sold for this month versus last month, and watch your gross margin on each type of offering very closely. If your gross margin changed, that is almost guaranteed to affect your cash and therefore your cash flow projection. So if I take my gross margin and subtract the rest of my operating expenses, I get down to a net margin. This might be a before tax number. And the expenses I'm subtracting here are typically overhead. So for example, the wages could be, if you have administrative assistants, if you have people who are at the cash register, they don't count as cost of goods sold. their time is an overhead expense. So wages or overhead, depreciation, which I talked about earlier in relation to fixed assets, is another expense. As I mentioned, it doesn't actually affect your cash, but it is considered an expense that reduces your taxable income. And then you might have other expenses which you just consolidate into one line on your income statement. They could be things like paper clips, electricity, any number of things. It's up to you to decide what you wish to have detailed specifically on your income statement and what you wish to lump in with a bunch of other things. In general, if it's a big number, if it's one of your larger expenses, it should probably have its own line on your income statement. If it's a whole bunch of $100, $1,000 expenses that add up to a number that is much smaller than the big expenses and not a huge factor in your profitability, then go ahead and lump it together with a bunch of other things and keep your income statement easier for you to analyze. Anyhow, looking at your net margin, so this is your profit after subtracting all of your expenses. You want to look at that again as a percentage of your sales. And in this case, my gross margin grew from 7% of sales to 9% of sales. So that's great. What's interesting is that my gross margin in dollars grew by almost 22%, whereas my net margin grew by 54%. Holy cow. If my sales only went up by 8%, but my net margin went up by 54%, that is superhuman change. How on earth did this happen? Well, my sales went up by 8%, but my costs only went up by 3%. So my gross margin grew quite a bit by $35,000. At the same time, even though my wages went up by 20% almost, they only went up by $12,000. Depreciation didn't change, other expenses by $2,000. So my expenses only increased by $14,000, while my gross margin increased by $35,000. So in this case, it's mostly the control of cost of sales that had the biggest impact on my tremendous growth in my net margin. My net margin number, as I mentioned earlier, is cash the business has generated. And when I go to do a cash flow analysis, I will add depreciation back to this. So 60,000 plus 50,000 depreciation means this business generated 110,000 from income before depreciation. Now that 110 will still need to be adjusted to reflect changes in accounts receivable, accounts payable, inventory, fixed assets, etc. But right here, by looking at the 60,000 number and adding depreciation to it, you can quickly see what the initial impact on cash has been from the income statement. So this number, net margin, is going to be typically your business's primary source of recurring cash flow. So a huge question is, was net margin consistent with your projections? If it wasn't, well, that probably explains a big difference in why your projections didn't match reality. Secondly, look at whether net margin changes a percentage of sales. In this case, it went up by 2% as a percentage of sales. And that's great, it's moving in the right direction. But understanding why it changed, in this case, most of the change was due to controlling costs of sales. So in looking at your income statement, questions to ask yourself: did revenue change as projected? Was your gross margin percentage on target? Was your net margin percentage on target? And if any of those were off relative to your projections, then they could have a big impact on why your projection was also off. So that covers all of the key points I wanted to make. And thank you, Frank, for pointing out I should include owner's draw there. Do you have any particular questions?
Hello.
Yes.
Fantastic presentation. I like it very much. Also, very happy that you mentioned when we have also positive effects, like example, increased margin. It should be also investigated because sometimes it could show things that are not planned or not expected, and it's important to know the reason to have the next steps. Thank you.
My pleasure. In general, all of the accounts on your balance sheet affect your cash flow. And
Yes.
if you have accounting software and you ask it to generate a statement of cash flows for you, it will automatically go through the change in every single account on your balance sheet and do the analysis for you, which is great. Here, I was focusing mostly on the accounts that tend to be the major reasons that
Yes.
cash flow projections differ from reality.
Yeah.
But all of them can have an impact.
It is.
Any other particular questions about your particular situation? Well, as I just mentioned, your cash flow statement is a very useful statement because it does the full analysis for you instead of just a quick back of the envelope analysis, which is mostly what I've been talking about in this presentation. So if you have an accounting package that supports producing a statement of cash flows, use that statement to get the full and complete detailed analysis of your cash balance. And when you understand why your cash flow projections might have been off from your last period, keep that in mind when doing your projections for the next period. And here's what a statement of cash flows might look like. It starts in the top section showing cash flow provided by your operating activities, which starts off with the bottom line from your income statement. It adds back depreciation, and then it looks at the changes in all of the balance sheet accounts that are affected by operations. Next, it looks at cash flow used by investing activities, and here it's looking at typically changes in your fixed assets, or if you were investing in something, in any investments you made. And then lastly, the last section is cash flow from financing activities. Here's looking at changes in your debt levels. Have you taken out a new loan? Have you paid down an old loan? Have you made principal payments on existing loans? And also in here, you might include owner's draws. And so your cash flow could be summarized by these three sections. In this case, $105,000 from operating activities, less $30,000 due to purchase of new equipment, less $60,000 repaying debt and taken out by the owner. And then, then at the bottom, it starts off by saying, okay, 105 minus 30 minus 60 gets you 15,000, which is the increase in cash for this period. If you add that to the initial cash balance at the beginning of the period, you get the ending cash balance. And so it's reconciling your checking account balance at the beginning of the period, $20,000, and the end of the period, $35,000, to say that, yes, the $15,000 change is completely explained by all of the factors above. In reality, most statement of cash flows are considerably longer than this because there are many more accounts that have changed. We've obviously simplified it considerably to get it to fit on one slide here, but the principle is the same, and you will see these three sections typically on your statement of cash flows. So when you go to make a cash flow projection, look at the numbers on here. They're the biggest numbers. And those are the accounts that you should think about in the course of doing your next projection. The numbers that are smaller, something that changed by $10 or $100, maybe you don't need to worry about those at all in your projections. Focus on the big players. Those are going to have the biggest influence on your cash over the period that you're projecting. Your cash flow statement explains exactly why your cash balance changed as it did. And I will say often there's too much detail there. My head swims after reading most cash flow statements. However, if you look for the big numbers, usually you'll find it's 3 or 4 or 5 accounts that have made the biggest change to the cash balance over the period. So if you find it challenging to try to understand the statement taken as a whole, don't worry, you have lots of company. Find someone else to talk with about it. Just talking through it with somebody else can often help. I find I have a lot of my best ideas when my mouth is open. And so there's something about just talking about it with somebody else that will help you have those aha moments that help you realize why things changed as they did. And then, as I said, focus mostly on the biggest changes and understanding them. And don't worry about the numbers that were $1 here, $10 there, $100 there. Focused on the numbers that are big relative to the size of your business. So, in conclusion, I cannot encourage you enough to reconcile your financials to your bank statement every month. If there's a discrepancy, it's really important to catch it sooner rather than later, because it could affect how you run the business and could lead you to run out of cash, which is bad. When you've finished reconciling, compare your actuals to your projection for that period, assuming, of course, that you've made a projection for that period. I encourage you to have a cash flow projection, looking out maybe only 6 months if that's all you're comfortable projecting. But even that helps you try to establish goals for yourself and try to meet them. If anything raises questions in your mind as you look over your balance sheet or your income statement or your statement of cash flows, pursue those questions. Try to chase down, why was that number surprising to me? Understanding why is perhaps the most important thing you can do as the owner of your business. And then as you gain insights into the operation of your business by reviewing your financials, write down any relationships among the numbers that you might want to keep in mind when doing your next cash flow projection. For example, if you say, well, my accounts receivable tend to be about 10% of revenues, that's a great number to jot down and use in your next projection. Or if my gross margin tends to be about this percentage of sales, that's another great number to use in your next cash flow projection. And sometimes those numbers become a goal in themselves for your business. If you say, oh, my gross margin is 12%, but the data I found from my industry says it's usually 15%, maybe your goal should be to try to increase your gross margin from 12% to 15% over the next few months by some combination of raising your prices and controlling the costs of what you acquire from your vendors. So the exercise of going through your financials, reconciling them, comparing a forecast, and thinking about why your forecast was off or why it was accurate, and then jotting down the relationships you want to use in your next forecast is a very useful process, because it helps you set realistic goals. And that forecast, if you go to a bank, looking for a loan, that forecast that's well thought through with well-documented assumptions will do probably almost more than anything else in helping to convince a bank to lend you money when you need it, assuming that you're worthy of a loan in their eyes. So the process is not wasted time. It will help you manage your business better, and it will help you talk about your business with a lot more authority and credibility. Because if somebody asks you a question and you've thought about it before, you can answer them to a much greater degree of detail than you otherwise would have been able to. And those extra little details you add in describing it that come from your having thought about it make your response that much more credible to the person you're talking to. So that's my pitch. Thank you for coming today. You'll receive an email in another day or two. Please respond to the survey. We're always interested in your feedback on these workshops. If you want to see more upcoming workshops, you can follow this link in the slide deck, which you'll receive in a couple of days as well in the same email, along with the recording of this workshop. And if you're not familiar with SCORE, we were founded in 1964. We offer free mentoring and workshops. We are a nonprofit and a partner of the Small Business Administration. We have about 320 offices throughout the United States. So if you'd like to sign up to talk to a mentor, if you don't already have one, you're welcome to scan this QR code, and that'll take you to the Find a Mentor page on our website and get you connected in a couple of days with a mentor that you can talk to about your questions about your business. So thank you very much for coming today. And I look forward to seeing you in future workshops, or who knows, perhaps even working with you as a mentor. Have a wonderful afternoon.
Thank you.